Bom dia a todos, obrigado por vir nessa hora cedinha. Vou fazer a apresentação em inglês. So welcome, this is joint work with David Gauthier, who's at the Bank of England. All right, so the question we're after in this paper is what drives business cycle fluctuations? And in the last decade, there's been mounting evidence supporting the view that financial factors, in general, financial shocks, are a major source of business cycle fluctuations. And typically the literature distinguishes two main channels through which financial stress impacts the real economy. So we have the household channel, that's been much documented in recent years, that involves house prices and household balance sheets and its role on credit and ultimately on household spending. And we then have the second channel, it's kind of the standard, the classic channel, the firm channel, that involves, again, asset prices, movements on firm balance sheets, and ultimately on firm credit and firm investment hiring. So we have these two huge literatures, and so in this big, in this vast body of work, what's missing here? So we argue that there's actually something that the literature is not able to explain, and that's the following. If you look at credit spreads on household loans and credit spread on business loans, so let me show you the picture right away. So here, the household spread is going to be the difference between interest rates on mortgages and the risk-free rate. So this is in the euro area. And here, the firm spread is going to be the difference between loans to businesses and the risk-free rate or the short-term policy rate. You see that the two rates move hand in hand. Correlation is very high. I can also show you in individual. So unfortunately, in the euro area, the data only starts in 2003. So we have here individual countries. So you see the correlation is very high everywhere, except for perhaps in Greece. And then we have also in the US, the correlation is also very high. So what this says, is that the two channels are actually always operating together. Okay, so credit spreads is a yardstick for credit, for lending conditions, for conditions in the lending market. So because the credit spreads move hand in hand, so you can see, by the way, that they increase in periods of recessions. Okay, so credit spreads are highly counter-cyclical. And therefore, when banks tighten, they tighten for households and firms at once. Okay, so this kind of rules out an explanation that would look at, if you look at the household channel, on its own, or the firm side on its own, you kind of miss part of the picture, given that the two are really highly correlated. So what we do in this paper is we kind of want to explain why is that the case, and we link that ultimately to consumer confidence. So here I actually plot consumer pessimism. So it's just the inverse of consumer confidence. So it's an index that's widely used and is known to be a leading indicator. So when consumer confidence drops, so when pessimism goes up, you see that shortly after the spreads go up, and this also happens in the second recession year of the cycle. So what we do in this paper is we build a simple theory that kind of explains why banks adjust their lending requirements, their lending standards, their interest rates, basically, simultaneously on households and firms, following a change in market sentiment, or a change in investor confidence, if you want. And so how do we link investor confidence to credit spreads? We do that through the business. So we do that through the financial sector. In particular, we have a financial sector with two types of financial institutions. We have the traditional banks that just make loans, and we have shadow banks that basically are engaged in securitization, and they are here to basically offload risk from traditional banks to investors. So I'll explain that there. So with this mechanism, we have an initial shock that starts from the household sector, from the consumer sector, from the investor side. We have all of a sudden we have a drop in consumer in investor sentiment. That's going to limit funding to shadow banks, which itself is going to lead into disengagement of shadow banks into the securitization market. So that's going to lower the price of securitized debt. Ultimately, that's going to lead banks to kind of compensate this drop in the price of securitized debt, which they sell to shadow banks, by increasing interest rates. Okay, so once we have this mechanism, we put that into it.
Hey, Eva, can I ask you one question, or
Sure.
should we
Sure. Go ahead.
So here, you're suggesting just that market sentiment as a trigger shock that will affect the shadow banks, it will affect both credits. So, but this is pretty much the same history people tell about the Great Recession, except that the trigger shock is the collapse of the bubble prices in the real estate. So can you have some way to disentangle why your trigger shock is more relevant or less relevant than other trigger shocks that people explored in the literature?
Right, so I think we're not taking a stand on how the market sentiment shock emerges. So it could well be, as you're right, I think so what's missing here would be why is market sentiment all of a sudden tumbling, and this could be linked to developments in the real estate markets, or it could be, so you're right that the 2008 recession was the trigger was kind of this thing happening in the housing markets. But here what matters for our purposes is that anything that happens that is going to have an effect on investor confidence, on market sentiment, will then, so we start from there and then we study kind of the propagation mechanism. Starting from so we're, in this model, the market sentiment shock is exogenous, and we're not taking a stand as why all of a sudden market sentiment falls. Okay. So once we do that, we estimate the model. So we put this model into a DSG model, that's sort of a dynamic stochastic general equilibrium model, which we estimate on Euro area data, and we find that this market sentiment shock is able to explain the co-movements in the two credit spreads. So we have one disturbance, one shock that can explain the joint co-movement in the two credit spread, and because of that, it's able to explain then a whole range of macroeconomic and financial aggregate, and we find that it's the main driver of business cycles in the Euro area. So this paper is linked to the literature that estimates structural models to understand economic fluctuations. We also speak to the literature on confidence expectation, even though we don't. So our confidence shock is basically just a risk premium shock in this case, but we are able to show that once so we don't really model as I just said, to do the way that financial shock, the confidence shock emerged. So it could be because of it could be a coordination problem, an information asymmetry problem. There are all sorts of explanations. Here we just take that as granted, but then we study the consequence, and we show that a confidence shock can explain a wide range of macro and financial aggregates, so the behavior of these macro variables over the cycle. And also our paper speaks to literature on shadow banking. The main theme here is that shadow banks provide a role that is kind of an insurance role for banks. So they basically offload risk. Banks have a lot of risk, and they don't want to assume this risk, so they basically transfer it by selling, by securitizing and selling, asset-backed securities, selling the loans to other investors willing to take this risk. And the shadow banks, they provide, they play the role as the intermediary. But the downside, the flip side, is that shadow banks make the financial system more vulnerable, more prone to more vulnerable to reversals in confidence. So let me describe the simple model here. It's a two-period banking model, and then I will, in the interest of time, I will kind of go very fast over the DSG model. So, two-period banking model. We have three types of agents. We have investors, banks, and shadow banks. Investors, they just save. So and they save into safe bank deposits, or either they put their money at the bank, or they buy some risky asset-backed securities. Banks, they use the deposits of investors to lend loans to the real sector. So we don't model the real sector. We just assume that there's a demand for a loan here. In the DSG model, of course, we'll have these houses and firms that are the borrowers. And then we're going to have the shadow banks that intermediate. I'll explain how it works. So investors, they basically live two periods, and they want to consume in both, and they have just an endowment in period one. So in period one, they're going to consume, and then they're going to save part of their endowment into either deposits or securities. And then in period 2, they will just simply eat the return on their assets. So they will eat their return on their savings, which is the return on safe deposits. So R is the risk-free rate. And then they have the return on the risky securities. If you maximize, you get the standard here condition that the supply is such that the return on risky securities will be equal to the return on deposits, bar here a covariance term that we're going to assume is our shock. So basically, we take this object to be exogenous, and we just say that this is our market sentiment shock. So you see that an increase in this term here, nu, is going to basically increase the spread between the risk-free, the interest rate here, the risk rate, so it's going to basically, an increase in nu will basically increase the premium that's commanded by risky securities. So that's what we call a market sentiment shock. Now the banks. So the banks, they borrow D deposits, and they have to repay in all states of the world. They must repay RD in the next year. So they cannot default on their liabilities. And but however, when they lend B, the loan they extend is risky. And so there's probability P that the loan will not be repaid, and probability 1 minus P that the loan is repaid. We assume that the banks lend to many borrowers, so that the probability becomes a fraction here. Very convenient. So the balance sheet of the bank is just assets equal to liabilities here in first period. If the borrowers default, the bank seizes the collateral that was posted. Okay, so that's collateral K, whose market price is Q. Okay, and we're going to assume that, of course, the more you lend B, the more collateral you're entitled to seize. Okay, so but this is an increasing function, but it's concave. So this is because this is to reflect the fact that the more you lend, so if you lend really a large amount, it's going to be harder to get the extra collateral. So initially, as you lend, it's easy to seize the collateral, but they're decreasing returns to this technology, because at some point, if you have lent way too much, basically, it's harder for the bank to go after the collateral. So this is meant to reflect the fact that there are some costs associated to cease, to default, to bankruptcy, and they're reflected here in this increasing concave function. So if the borrowers default, the bank seizes the collateral, and then there is a risk here that the bank cannot diversify. It's this omega. So we're going to have, once the bank seizes the collateral, the value of this collateral is subject to this omega shock. And so think of just omega, being could take two values. You have omega low or omega min and omega max. So the bank does not know when it lends what's the omega it's going to hit in the next year. Okay, so if the bank was not securitized, it would lend B at the rate RB. So this is the fraction of borrowers that do not default. So the expected profit in period 2 would be, this is the fraction coming from those who do not default. This is the fraction that comes from those who default. So those who default with probability P we seize the collateral QK, but of course the shock omega here could be omega min or omega low. And then this is first the expense of the bank. We have a solvability constraint because the bank must repay the depositors at all states of the world. The bank therefore must consider the worst case scenario, which is omega min here. So because of that, the bank is constrained in its lending. So if you maximize profit, the optimal lending condition is as such. Now, if the bank has the option to securitize, it can sell the part of the loan portfolio that is risky to a shadow bank before knowing the shock that is going to hit. So instead of waiting to get its shock, omega, it can say, okay, I'm going to sell this loan portfolio to a shadow bank at price Q tilde. Typically, Q tilde is going to be lower than Q. And so this uncertainty becomes transferred, the risk becomes transferred to the shadow bank. And me as a bank, I know exactly what I get Q tilde. And because of that arrangement, if I maximize, I get that the optimal amount of lending is as such. And because we make the assumption that the price at which the bank sells the loan is higher than the worst case scenario, otherwise the bank would not engage in this agreement. And because K prime is a decreasing function, remember, because K concave, we find that there's actually more lending in the case where the bank can't securitize. So under securitization, the bank is going to be able to lend more for a given amount of collateral. The shadow banks, what they do is they buy the assets of one individual bank, but they do that for buying the assets of all the banks. So they manage to actually wash away the idiosyncratic risk. They buy, and so because they lend to basically take loans from many, many different banks in the country, they are able to combine this into a safe security, an asset-backed security. And the banks, they have bought the security as price Q tilde, but this security is actually worth Q because it's the market value of the collateral. So therefore, the shadow banks are able to make a profit here. This profit is actually the return that the shadow banks is going to pay to the investors. Okay, so if we combine this equation, the first order condition of the shadow bank, the first order condition of the bank, and the first order condition of the investor, we get an equilibrium that this following equation. And now suppose that you have an increase in the risk premium, so you have a negative market sentiment shock, so you have a fall in confidence, an increase in mu. It's going to lead to an increase in K, all else equal, an increase in K prime B. And because K prime is increasing, you have a fall in B. Okay, so an increase in the risk premium is going to basically lead banks. So remember, mu goes up here, so the interest rate on securities must go up. So that means that banks, shadow banks, must pay a higher return. So this price Q tilde must go down. So because they have to pay a high return, they need to buy the securities at a lower price. So the demand for securities goes down and the price goes down. And ultimately, this hits the profitability of the bank because the price Q tilde goes down. So the banks, to compensate, must either decrease B or increase the interest rate. So we have the result that an increase in a fall in market sentiment leads to a fall in lending or an increase in the spread in the interest rate market. So that's our result here. Okay, so I hope I was clear in the intuition. Okay, so again, drop in consumer in investor confidence leads to a retreat. So investors want to go away from the risky securities. So shadow banks have trouble raising funds. Therefore, shadow banks buy less securities. So there's less securitizations, and banks are less able to sell the securities, and so banks have to compensate by increasing the interest rates they charge on their borrowers.
Hey, Ivan, perhaps it's too early for this question, but at the end of the day, all you need is to increase the cost of loans. So why not shock directly the discount factor and call it a discount factor shock? Probably you're going to get an increase in the risk premium, an increase in the cost of borrowing, and that's it. This whole structure, and my feeling, at least, looking towards your explanations, that by shocking the discount factor, you're going to get similar results. You're going to have an increase in both spreads.
You mean the stochastic discount factor of the bank or of the?
No, the discount factor of the consumer. The discount factor.
The investor. Yeah, but that's what we have, right? If you think of, nu is the covariance term here divided by the stochastic discount factor. So it is indeed a so. But the question is, why does a stochastic discount factor shock on the consumer side lead banks to tighten across the board? So here the mechanism is there is a stochastic discount factor shock in the consumer. On the consumer side, this propagates to the shadow banking sector, which leads to a fall in the price of securities, which leads to banks to compensate.
So without the you need the shadow banking to
right. Without the shadow banks, you don't have an immediate link between. So you just have you have investors that are more wary, so you could have a fall in stock prices, but it's not clear why banks would. It's actually you have investors they're actually flying for safety. They're going for the safe asset. They're going for more deposits. That's what we observe in periods of stress. Investors flock to deposits. So actually banks, they have more funding because deposits go up. Yet banks tighten. So why do they tighten? Because you have the shadow banks that are in the middle that are struggling. So that's the link here. Yes.
Ivo, just to point out, you have 10 minutes left. Okay.
Okay. All right, so we estimate the model. I'm going to skip the DSG part because I want to show you the results. But basically, in the DSG part, we have two types of borrowers, impatient households and entrepreneurs. So now we have two types of households because we have the saving households, the investors, the patient, and the impatient. Okay, and then we have both impatient households and entrepreneurs, the two types of borrowers that can default. And because they can default, there's a risk, there's a spread over the risk rate. And how does that play out? We have banks, again, so we see the same constraint. Banks, they lend to impatient households, I. This is the share that repays, and this is the share that does not repay. And in that case, the loan is sold to the shadow banks at price Q0. So we have actually the price of mortgage-backed securities and the price of capital-backed securities, if you want. And the shadow bank actually, acts in so its first order condition kind of unifies the price of these two assets. Okay, so we estimate this this model with a bunch of shocks. The data we use is standard. We have macro data, and then we have credit to house, credit to firms, credit spread on households, credit spread on firms, and we have house prices. And we estimate this with Bayesian methods. What do we find? Oops. So this in blue we have the data, okay, and in orange we have the what's implied by the model with where you shut down all the shocks except the market sentiment shock. Okay, so there are 12 shocks in the model. Here we shut 11 of them down, and we keep the market sentiment shock. And we see that actually, and we see how the model responds. And we see that it's actually pretty close, and in particular for the two spreads, the model is matches the spread very well. So the model hit by one disturbance is able to reproduce the dynamic behavior of these main macro and financial variables. Another way to see that is to compute a variance decomposition at business cycle frequency. And you see that the market sentiment shock explains over the period 50% of the variance in output, 49% of the variance consumption, and so on. And also explains a huge share of the variance in the credit spread. So based on this evidence, we say that the market sentiment shock is the main driver of business cycle fluctuations in the euro area over that 20-year period. Why is that so? So a market sentiment shock is going to, as we've seen, lead to an increase, a fall in the price of securities, these two housing and capital price securities, which ultimately leads to an increase in the spread that banks charge to households and firms. And once you have an increase in the spread, you have a fall in the household credit, which leads to a fall in consumption. Once you have a fall in a rise in the spread to firm, you have a fall in the firm credit, which leads to a fall in investment. Less investment and less consumption leads to a fall in output, fall in hours. So all this behavior that the model implies is actually what we observe in the data, because we have pro-cyclical consumption, investment, and work, and also counter-cyclical spread. So the reason why the shock is able to explain such a large share of the variables, because it actually generates dynamics that are the ones we observe in the data: pro-cyclical consumption, investment, hours, and credit asset prices, and counter-cyclical spreads. Okay, and last thing we do is is this story plausible? So what we do is we take the shock coming from the model. Okay, so this is a time series of the estimated market sentiment shock, and we put it and we compare it to a measure of financial stress, which we did not use in the estimation. Okay, so this is a measure of systemic financial stress computed by the ECB in Europe, and you see that the correlation is fair enough. So given that this is something that comes from the DSG model, and this is the actual data that we have. So we link our market sentiment shock. We think that it's a fairly good gauge of financial stress or market sentiment, if you want. And then the last thing we do is we estimate, so this is following a recent AR paper where, okay, we take a VAR, we take the same 11 series, we actually put also this series, this blue series an additional, so we have 12 series. We estimate the VAR where we identify a shock such that the shock has the maximum effect on output. So we estimate the VAR, we find the structural shock such that the shock has the maximum impact on the volatility of output. Okay, so we call this so then we do the same operation by now estimating a shock that has the maximum volatility on the financial stress index. So we have two VARs estimated independently, where just one shock maximizes the effect on output and the effect on stress. And this is what we get. We see that if you do that, the two shocks have virtually the same effect. So the main business cycle shock that's identified on targeting output is kind of indistinguishable from the one this is the financial index operator. This comes from the VAR, so this has nothing to do with the DSG. And now we just compare that with our market sentiment shock that comes from the DSG. Okay, so this is basically to kind of validate the transmission mechanism. One comes from the structural model, the other one comes from the much more flexible statistical framework, which is the VAR. And we see that, of course, it's not perfect, but still the dynamics are kind of the same for most variables of interest. Yeah. And okay, do I have time? Okay, let me conclude and then I'll just show you.
Yeah, you have just 5 minutes left.
Okay, so maybe I can show. So just to show, this is the model without the shadow bank. So we take the same DSG model, we remove the shadow banks. So by the way, if we remove the shadow banks, going back to this question, the market sentiment shock no longer has any effect because it cannot propagate to. So in that case, when we estimate the model, we find that it's actually the risk shock of Cristiano Motoro-Stagno that becomes the main driver of this cycle. But the firm, so we call it the firm risk shock because there's equivalent risk shock on households. So the firm risk shock is able to explain very well. So this is the spread in the actual spread. And this is the share explained by the firm risk shock. So you see that most of the variation in the spread is explained by one shock, which is the firm risk shock. But the firm risk shock has no effect on the household spread. And instead, it's the household risk shock that can explain most of the variance in spread. So basically, without the shadow banks, you have the way that the model matches the two spreads is by having one shock that explains one spread and the other shock that explains the other spread. In our baseline model, our market sentiment shock is able to match the movement into two spreads. So we have one shock that explains the movement in the two spreads and in other variables. Okay, so another way to see that is that with the shadow bank, so the market sentiment shock explains the covariance of the two spreads, almost all of it. But if you take the model without shadow banks, then the firm risk shock contributes negatively to the covariance, and same for the household risk shock. So basically each shock explains its spread, but they cannot explain the covariance, and remember the correlation is super high in the data. All right, so let me conclude. Household and firm credit spreads move in lockstep, and they spike in each recession. We propose a simple mechanism that kind of rationalizes this, and this mechanism is that we have actually investor sentiment. So maybe we could actually really talk about a stochastic discount factor shock, but basically we want to explain how a stochastic discount factor shock propagates. How does that lead to banks tightening? And we showed that this goes through the shadow banking sector and goes through the price of securitized assets. We take this model to the data and we find that market sentiment shocks are able to explain the movement in credit spreads and are also a major force driving this sector. Okay, thank you.
Thank you, Ivan, for the presentation. As we have no questions here on the chat, I think, if someone has some issue. Well, as we have no questions here, I think we can move on to Thomas, maybe.
Okay.
Okay. Thank you, Ivan.
Welcome.
I think you, okay, yeah. So 30, 30 minutes.
Yeah, everything's fine, right? Can you hear me? Can you see my slides?
Yeah, perfect.
Should be working. Okay, perfect. Right, so this paper is joined with Andres and Luisa that are at the University Carlos III in Madrid. And I'm going to talk about public finance and economy with financial friction in the liberal economy. It's going to be no business cycle at all, so we're going to move from one thing that we just saw with Ivan to a completely different thing here, but there are financial frictions there, right? So this paper starts with the main motivation of developing economies, right? So these three characteristics of developing economies of having a large informal sector, underdeveloped financial market, and a large fraction of entrepreneurs. And here, entrepreneurs are not just business owners, but small own accounted workers, that guy selling caipirinha in the Copacabana beach or whatever. Okay, so the idea of this project is to understand how those things interact with each other, right? So whether there is any meaningful interaction specifically between informality and financial friction. And precisely, we want to ask whether this improves or worse resource allocation in the economy. And since informality is a type of tax evasion, we can actually study how this affect public finances in general, right? So social security system, whether it's better, which tax instrument that we should use, and so on and so forth. So before I go, let's think about why this interaction matter and why we should think that there is an interaction. So first of all, we could think that informality might have a negative effect in the aggregates just because it's a type of size-dependent policy, right? So informality creates an additional incentives to entrepreneurs to remain small, right? Otherwise, if they grow too large, they can get caught and receive a fine from the labor authorities. Now, informality also allows unproductive entrepreneurs to operate, right? So those unproductive entrepreneurs, they might use resources that would be better allocated in more productive, more large and unproductive entrepreneurs. However, in the context of financial frictions, informality might have a positive effect and a dynamic positive effect. And where this comes from, you can think that there might be productive but financially constrained entrepreneurs and can benefit from this type of subsidy, right? So they can use informality to speed up capital accumulation and eventually undo the financial frictions, right? So and reach the optimal scale. So even though you could think that if you're aware of the effect of size-dependent policies, you know that's a type of static distortion in the economy. But in this case, combining financial frictions, it has dynamic and a potentially positive effect, okay? So we're going to use an interpretation model. We're going to assess the effect of formality on capital accumulation, occupational choice, and then study public financing. What is key in our model, we're going to borrow from Gabriel's paper, the AR 2018, there's two margins of informality, right? So if you're not aware of what are those two margins, so in Gabriel's paper, he defines the extensive margin at the decision of an entrepreneur to not register her business. So this is a firm that is fully informal, right? And the intensive margin as the decision of a formal entrepreneur or a formal firm to hire some workers off the book, right? So this would be a firm that is registered with the tax authorities, but it still hires some informal workers, okay? So this would be a firm that is partially informal. Now in Gabriel's paper, there is no capital, there's no financial friction, nor capital or anything, nor an occupational choice. And occupational choice is potentially responsive, especially because many of those entrepreneurs, those small entrepreneurs, they are at the margin. So any policy affecting that might swing them to either become workers or switch sectors, okay? Now we're going to calibrate that model to Brazil. There's nothing special about Brazil, apart that we are either from Brazil or live in Brazil. But in general, Brazil is a good experiment because it has the two margins are very important. I'm going to use that model to perform a bunch of quantitative experiments. Now, why those two margins are very important, and that's something that I'm going to concentrate here in this presentation, is because they have different implications to the economy. So first of all, in this simple model economy, informality will be bad, right? To have a negative effect. So if you eliminate informality, we're going to have a positive output and increase in TFP in general. But the extensive and the intensive margin will have completely different effect, right? So if you eliminate the extensive margin, but keep the intensive margin, so we eliminate the fully informal entrepreneurs, but allow these firms to hire some informal workers, we'll have a positive, a higher effect than if you eliminate both margins. So in general, in this economy, formality will reinforce financial frictions, right? We'll have will reinforce the negative effect financial frictions, but the distortion is going to be highest without an economy, without the intensive margin. Now, let me give you a brief intuition of why is that. So the intensive margin would be act as a subsidy to small business. Now, these small businesses are exactly at the margin of being formal or informal. If you take out the subsidy, right, what's going to happen is that most of those small businesses are going to switch to the informal sector, where the incentives to remain small are even stronger. Now, with financial frictions in the formal sector, those small and productive entrepreneurs, they have a stronger incentives to accumulate capital and grow. So if you bring those guys to the informal sector, they are precisely not growing at all. They become smaller, and this is going to decrease TFP, in this economy. Okay. Now, what is nice is that the results in public financing here, they're going to be very interesting. I'm not going to discuss all of them, but in general, they have very meaningful interactions. So if you just attack one margin or the other, they're going to have a completely different effect. But if you attack both together, so the joint effect of formality would be larger than the sum of each margin separately. So they have actual interaction with each other. I'm going to discuss this a little bit.
Thomas, can I ask a question? What
Sure,
happens if you remove the financial friction because you didn't really show it? Is that gonna how are your results affected? Yeah,
so basically the intensive margin has a positive effect precisely because there is financial friction. I'm going to give an intuition when we talk about the distortion of the model, but the financial friction is key. If I have the model without financial frictions, pretty much informality is going to be bad, but you know, the positive effect of the intensive margin will not be there, or will be much smaller. Okay, but financial friction is going to be key. And the financial frictions in fact matter for the optimal tax instrument. So in an economy with financial friction, payroll tax is much more distortionary, right? While in the present, if you remove financial frictions, actually other tax instruments might be more distortionary. So financial frictions would be key. Okay, so I don't have too much time, so let me discuss briefly some empirical facts here. So as we are all from Brazil, or we live in Brazil, at least most of us, we pretty much know those facts. It's in general, entrepreneurship rate in Brazil is large, and entrepreneurs here are everybody, even the guy who fix your sink, or the guy who selling stuff on the streets, and they are 32%. This is in the macro development. This is well known, right? Underdeveloped countries have a large entrepreneurship rate, and in Brazil, more than 2/3 are informal. Now, those informal businesses, they are small. They employ at most 2 workers, right? And pretty much no small business, no informal business employ more than 5 workers. Now, if those informal businesses are small, where are the bulk of the informal labor? They are precisely informal firms, right? So here this is PNAD data, right? You can always do this experiment yourself. This is 2012 PNAD. Basically, you can separate the worker firm status by formal worker, by the formality of the worker and the formality of the firm. And so here you have 3 pairs, right? Formal work and formal firm, informal worker, informal firm, and informal work and informal firm. So this is the employment share of Brazil in 2012. Now, if you take all the firms of all the employment, you see that 78% are formal workers in formal firms. So 22 are informal workers. Out of those 22 informal workers, 14%, so around 60% of all the informal workers are informal firms. And, they are present in large firms as well, right? So that is 8%, roughly almost 8% of those informal workers out of all the large firms, they are informal. Okay, so informality is present in large firms, and they are mostly, at least informal workers are mostly in the informal firms. Okay, so we have those 2 things. We have the extensive intensity margin, that they matter. What about financial frictions? Let me briefly discuss a little bit. So in general, we know that formal firms, they hold more capital and debt, but it's not a fully separation such as, you know, you have this informal firms with almost no capital, no debt, and the formal firms with a lot of capital and a lot of debt. In fact, if you just take...
Can I ask a quick clarification question? How do you measure capital among informal firms?
So, sorry, large capital? Can you ask again?
Okay, how do you measure capital among informal firms? Is it something you observe?
Okay.
How can you make comparable to the capital informal firms?
Okay, so this is a CINF. So this is the informal survey, 2003, right? So this is just a small business, and in small business, in that survey, they actually ask the amount of capital, the type of capital, if it's structures, if it's so.
But that survey also covers the formal sector.
Yes, only small formal sector. So
okay.
So this is condition. So what the distribution I'm showing are first small firms, so they are less than five employees, and also young firms. So firms they operate for less than 1 year. Okay, so those now precisely because they are just entrants. The adjustment costs and all sorts of other things did not hit yet. So, and if you look at that, there is a large overlap in distribution between the two sectors. So this is actually at odds with the fully separation that, you know, some papers assume when talk about informality, right? So what we want a model that can address both the intensive margin, the extensive margin, right? So informality in both sectors, but also that can have this overlap distribution of capital and debt between the two sectors, at least in small young firms. And that's what we're going to try to address here. So we're going to have a model. The model is going to have heterogeneity in assets and entrepreneurial idea. Occupational choice, the households can choose to be worker, formal, and informal entrepreneurs. With certain probability, they become a retiree, receive a fixed pension, eventually die. So if they're entrepreneurs, they're going to be subject to financial friction, fixed costs, and entry costs. A formal entrepreneur can pay sales tax and payroll tax, and they can hire both formal and informal. An informal entrepreneur hire only informal labor. We're going to have corporations, but they are just there for the quantitative part. That's not really relevant for the results. So I think it's easy when you see the problem. So this is a static problem of a household that is an informal entrepreneur, decide to be an informal entrepreneur. So very standard, span of control technology with decreased returns to scale. This entrepreneur hires informal labor. It's an informal entrepreneur, so he can only hire informal labor. Rent some capital, pay a fixed cost, and is subject to financial friction. Financial frictions here is going to be just a collateral constraint, so nothing very fancy. And what maybe is less standard is that we're going to have this L bar, but this L bar here just represents the entrepreneur own labor. So these help us to have, you know, a bunch of informal entrepreneurs that do not hire anyone, right? So they use their own labor to produce. What is also very important is that the parameters here of technology, we allow them to be different, right? So this is a matter of calibration. I can discuss this later, but the parameters of technology and the collateral constraint can be different across sector. Now, a formal entrepreneur, first of all, has to pay taxes. It has to pay sales taxes over production, can hire both formal and informal labor. Formal and informal are fully substitutes in production, right? So it doesn't matter if he hires formal or informal, at least for production. Now he has to pay payroll tax over formal labor only, and are subject to financial frictions, and can use their own labor. Now you can start to think yourself, look, this formal entrepreneur, you know, formal and informal labor are substitutes to production. So, and the formal is more costly because it has to pay a tax over the formal labor. So why he doesn't the informal entrepreneur only hires informal labor then? Well, we have this tax function. This tax function, this tau function basically captures this probability of getting caught, right? So, and it's convex and increasing. So this is going to capture, you know, the labor audits that the government can knocks on your door, and can give you a fine. Now, this is very important. So let me go into detail of this tau function. Basically, this tau function is going to comprehend this cost of hiring informal workers, right? So this is convex in the informal part, but potentially is decreasing informal workers. So what this means is that this firm would basically hire informal workers until the marginal cost of an additional informal worker equalize the marginal cost of a formal worker. Now this function is going to be very flexible, and it's going to give you a very intuitive and interesting property, which is the number of informal workers will be increasing firm size, but the fraction of informal workers is decreasing. So you can think that a firm with 10 workers would hire 6.4 informal, while a firm with 100 workers will hire 18.4, right? So they're going to hire, large firms would hire more workers, but relatively less out of total labor. Now that's probably the most important slide. So I want to give you the whole intuition. Now, informality here, it's a size-dependent policy. Well, why? Small firms would basically pay as a fraction, will have a different effective payroll tax rate than larger firms, because they hire relatively more informal labor, right? So as a firm becomes larger, you can think, if I plot here just the payroll taxes, which is calibrated to 29, and I plot the effective payroll taxes, how much those firms pay in payroll tax effectively, right? When you sum the entire labor units, including both informal and informal labors, you can see that is this increasing function. Now, asymptotically, when the firm size goes to infinity, those two lines connect. So this is going to generate a reallocation of resources from large firms to smaller firms, right? So it's cheaper to hire labor in small firms. So we already have two types of distortions here. So the first type of distortion is, ignore financial friction for a moment. If you think that in a world where there's no distortions at all those firms are gonna equalize the capital labor ratio. Now, we have the extensive margin. So the extensive margins has a different type of technology. So these already imply different capital labor ratio across sectors, right? So this is one type of distortion. Now, the intensive margin is going to generate going to distort the capital labor ratio within the formal sector. So those are two types of distortions. Now, what we know from the literature that size-dependent policy, they are not as strong here, and precisely because they maintain the same rank, right? So usually larger firms are the ones that are more productive. However, when we introduce financial friction here, this rank is break. We're going to have a lot of very productive firms. They are small, precisely because they are financially constrained. Now, this is where the intensive margin acts and enters a subsidy, because it helps those firms to grow eventually. Okay. Now, the other part of the model is relatively standard. You know, the dynamic part of the model is just a household that makes consumption savings. If she's a worker, she's going to earn a wage, makes a dynamic operational choice. So next period can remain a worker or paying an entry cost to operate as an entrepreneur. Eventually, they are subject to idiosyncratic shocks, right? With certain probabilities, they can resample that idea, that productivity idea. If she's an entrepreneur, this household is going to earn the profits that of that maximization problem that I showed before, and he can make a decision of operating or exit. Now, standard, we're gonna evaluate this model so far in the steady state, and equilibrium is going to be standard, right? So we're going to have wage and interest rate that's going to clear that is going to clear this the labor and asset markets. Okay.
Was just to inform you, have 10 minutes left.
Okay, perfect. Yes, perfect. Okay, going to calibrate this model, size distribution of formal and informal sector, capital output ratio and debt to GDP of both formal and informal sectors. So this is always targeting small business only because that's the data that we have. And we're going to also calibrate by the fraction of informality in both fraction of informal workers, fraction of informal business, and fraction of informal workers, informal business. I'm not going to discuss too much. The model does actually a good job in, at getting the distributions and everything right. But I think it's more important that, you know, this model actually gives a high rate of entrepreneurship that it's present in Brazil, and it gets correctly the aggregate tax revenue to GDP, which is something that is we were quite happy actually. We're expecting when we did that in the first place. Now, what I showed the distribution of capital and debt of the formal and informal sector before, and in the model we actually have also a common support, which is something that comes from the idea that comes from the financial frictions, right? So we're going to have a lot of those informal but financially constrained firms that hold very little capital, and some informal firms, they are not as productive, and they decide to operate in the formal sector because they never think that they would grow larger. So we can have this overlapping distribution of both debt and capital. Okay, so I have roughly 8 minutes to talk about the results. Let me talk about a little bit about the results here. So first, let's understand what informality does in this model. So we're going to do one simple experiment. We're going to shut down each margin and then shut down both together. We shut down one margin. Shut down the intensive margin has negative effect. Negative effect on output, negative effect on TFP. Shut down the extensive margin, completely the opposite, right? To have actually positive effect. Now, probably the most surprising part is that shut down both together, then we still have a very large effect on output and TFP. So definitely the sum of the joint effect is precisely very different from the joint from the sum of each effect separately. So there's a lot of interesting interactions in there. Now, where are the response of that? The response of that is a lot is coming from the occupational choice. Now, if I just plot the occupational choice of this model, we're going to see that you take out intensive margin, you take out that small subsidy that small formal firms were having. A bunch of those small business are now becoming an informal entrepreneur, an informal business. Now, on the other hand, you shut down the extensive margin. You have that some of those previous informal business now will move to the formal sector, but some others now become paid workers, right? So you can see that the occupational choice has a lot of response. Now, to understand the joint effect, it's interesting to see them together. You remove the intensive margin, remove that implicit subsidy, what happens? When they had the option to go to the informal sector, they all moved to the informal sector. But now we remove the informal sector altogether. So many of those guys now are moved to be paid workers. And in general, this is going to be, only the most productive entrepreneurs remain operating. So this is basically the benefit of having the intensive margin. A lot of the benefit of having the intensive margin is precisely because they have the option to go fully informal. If you take out the option, the benefit of the intensive margin disappears. And the intuition here is because the intensive margin subsidize those small entrepreneurs at the cost of those large ones, right? And precisely because we have financial frictions, we have a lot of small but productive entrepreneurs with high returns to savings. Having the intensive margin prevented those guys go full informal and never grow. And of course, if we take out both together, we can have that, remove both together, we have the effect of the extensive margin will now, we now have a negative effect, as we saw, but also we reduce the effect of positive effects of the intensive margin. So the intensive margin has a positive effect, one, because there exist financial constraints in the economy, and two, because there is the option of go full informal. Now I won't discuss there is plenty interaction with financial frictions, so I won't discuss that. I prefer to just go briefly on just what is the
Thomas,
role of,
just one quick comment. It would be very nice if you also report a transition across jobs and sectors, because if I understood correctly, the results depend a lot on that occupational choice. I know you cannot validate externally those transitions with Brazilian data, but at least you can get a sense of how much mobility you have across sectors, if these numbers are something reasonable, if your model is generating something reasonable regarding those margins.
Yeah, I agree. That's something that we are working right now, but it's a fully agreed comment. Okay, thanks. So yeah, go ahead.
Sorry, I have a question as well. Seems to me that your results are also partially derived because the interaction between your lambda, so your friction, and informality, right? But my doubt is like if the correlation between lambda and informality, it is not positive. So let's say it is not the firms that are most constrained that have the informal workers, then you wouldn't see that positive effect. Is that right? I don't know if I understood correctly your model.
So yes, but in the model, that's precisely what's going to happen. I can give you the intuition in the next slide. But that's precisely the workers, the more constrained workers are the ones who are going to have. So the firms that are more constrained are exactly the ones who are going to hire more labor. Okay, so they are precisely the ones who are benefit by this subsidy. And this is a property of this type of model. So this, no matter, it's not my model. If you have this type of collateral constraint, this is going to happen. I can show you this in the next slide in the few minutes that I have. Okay. But yeah, of course, it depends that the correlation. It's of course very important. And let me actually briefly address that. So, of course, let me finish the presentation with a couple of minutes answering that question, because I think that's it's a very interesting question and very relevant. So, of course, the constrained firms are the one, in this result, which they are the one who should benefit from having a benefit, for having this subsidy in labor. And where did this show up? Well, let's take first order constraint, ignore the slides, is for public finance and other things, but let's take the capital labor ratio. Now, capital labor ratio in this type of model with this type of collateral constraint, the collateral constraint is going to show up as a multiplier here. And this multiplier is going to be higher, the more productive, and the higher is the Z, so the more productive firm are, and the lower is the assets, the less as you have. So this is going to be heterogeneous across firms, right? All the others are, all the other elements are the same across firms. Now, the more constrained the firm is, the more labor relative to capital it's going to use. So the subsidy, so a labor tax, are precisely very distortionary in an economy with financial frictions. So the intensive margin actually helps those guys to undo, because it basically gives a subsidy to the firms that mostly need, to the ones that have higher saving rates. And we do a bunch of experiments with, you know, switching fully, taking out the entire labor tax and giving and financing the economy, financing the government expenditure using the other tax with financial friction. And removing the labor tax altogether actually generate positive effects in economy with financial frictions. In economy without financial friction, this effect has the opposite sign, precisely because there's this, the labor tax is so distortionary in an economy with financial frictions, okay? So I think I should conclude.
Yeah, if you kindly
so I should conclude. I don't. I couldn't discuss too much of the discuss on the public financing, but I think that the question gave me a good hook to. And what I want you to take out of this presentation is just that those interactions matter, right? And they matter because, well, not only because of financial frictions, but also because different margin formality interact together, okay? And these have important implications for public financing in general.
Okay, thank you, Thomas, for the presentation. It was very interesting. I think we have one question here on the chat. I don't know if you wanna.
Let me check the chat here.
Yeah, I can spell as well. Is
yes.
the...
No, I just saw it. Don't worry.
Yeah.
Oh, yeah. The wage rate is the same for both sectors. The baseline is the informal sector also more labor intensive. So first, yes, the wage rate is the same for both sectors. There is only one price of labor here. The baseline model is the informal sector also more labor intensive? It is. This is calibrated to match. We have the intuition in the paper, but yes, this we basically take the capital to GDP ratio in both sectors, and we make the full argument that this is necessary to match the capital intensity across sectors. But yes, the informal sector is also more labor intensive.
Okay. I think that's it. If someone else has more questions.
Good job, Thomas.
Okay, nice presentation.
Okay, so let me. Okay.
So let me share my screen here. So. Okay, thank you all for coming. Let me adjust my clock here. My paper, this is my master thesis presented in PUC-Rio, so I think it's an ongoing job, and any comments and feedbacks are very welcome. Okay, and this is, I think I try to make this title very straightforward. So we are looking to two literatures, okay, so the literature from foreign exchange interventions and the covered interest parity deviations, right? So the idea here is to link these two literatures, a large literature of foreign exchange interventions, right, and this flourishing and more new one literature about the CIP deviations. And my idea here is to convince you that I do this in the correctly way, okay? So first of all, some thoughts on the CIP deviations, just to put everyone on the same page. So what the CIP deviation states, it states that the interest rate differential between the two countries must be the same, must be equal to the forward premium between the currency in these two countries, okay? And in those two economies. So basically, the forward and the spot currency must be equal to the differential of the interest for the same maturity. So this is basically the what CIP states, and CIP any deviations by the theory could lead for a profitable and risk-free operation, right? So since all the returns are known at the period the transactions are made. If you have some deviations, you expect that deviation be by arbitrage be take to zero, and the equation to holds. Okay, but this is not the case for the emerging markets. So we see this the CIP being violated in emerging markets for a long time. Okay, and this is mainly due to capital flows mobilities, and we have risks. We have country risks. Okay, we have convertibility risk and this kind of stuff in emerging markets. On the other hand, in the G10 currencies in the developed market, this equation used to hold. Okay, but since the 2008 global financial crisis, we have been observed some deviations on this parity as well. And how we link this to the FXY literature, the foreign exchange interventions literature. Basically, we are looking at the forward premium. All right, so we think that when depending on the way you intervene on the spot market or on the forward market, you have some pressure on the forward premium, and this could lead to a edge between the interest rate. All right, so let me show an example, illustrate what we are trying to capture here. Suppose we have a sale of foreign currency on the forward market exchange. So the central bank is selling dollars on the forward market, for example, for instance. Think that in Brazil. And what we expect is some downward pressure on the forward market, on the forward exchange rate, right? So the central bank is selling. We expect the foreign currency to a downward pressure, right? Decreasing the forward premium. And since the interest rates remain unchanged, we may see some edge in the at least the short term, right? And here I illustrate some the mechanism here in Brazil. I'll explain later, but here in Brazil we work with the cupom cambial. It's a derivative here. And the idea is the same. Basically, we have the cupom cambial, that is the interest rate, the local interest rate minus the forward premium. Okay, and when we have this intervention here in the forward market, we see a downward pressure on the foreign exchange rates, and the coupon have to adjust since the international interest rate remains unchanged, and this led to a edge between the coupon and the international interest rate. That the coupon and international interest rate must be the same if we don't have this deviation. It's basically the idea. And this is actually the mechanism. We think it's working behind this fact. And what we do in this paper, as I said, we link these two literatures. So we basically are adding another factor for the another variable for the CIP deviations literature. So since the global financial crisis, we are seeing many papers trying to understand what could lead to these deviations, and a lot of variables such as the capital flows, mobility, and these kind of things. And we add to this literature by studying the interventions, right? The data we use data from Brazil, basically. So we have interventions. Our sample goes to 2009 and to 2020 until now, basically. And especially we have a focus on a program that the central bank did on the 2013 and 2015 of pre-interventions, daily pre-interventions on the exchange market, right? And this is a focus we do in this paper as well. And the methodology, first we use the artificial counterfactual. So we build a synthetic Brazil CIP deviations, controlling for other countries and peers to understand how this program led to a change on the CIP deviations. Okay, and in the second moment, we use local projections to study the interventions, the effect of interventions on a more broad way. And just to clarify here, the ARCO we use for the program and from 2013 to 2015, and local projection we use from the rest of the sample to 2009 and 2000 until now, right? And some results we have until now. We see that the program between the 2013 and 2015 actually led to a higher deviation for Brazil. Okay, and this is also corroborates for the local projection. We see that we have a positive impact on this, and this fade out on the middle term. But the program, as the whole program, has this impact. Okay, we have also investigate some effects of repo credit lines. This is another kind of effects interventions, and we have some results in the local projection showing the effects, but this is a short-term effects. Okay, it's not big and longer as on the program. And in the spot interventions, we have some inconclusive results, but we think this is we are still working on that. We maybe have some issues on the sample that I will point out on the next. Okay. So the related literature is basically the CIP deviations that I mentioned. So it is it's a brand new literature investigating what caused the deviations on the G10 currencies, okay, since the 2008. And we also have this large literature that we borrow some thoughts and some results to put in the CIP deviations. And just to point out the FXI interventions, I think it's interesting literature because they have, I see the papers in two waves, basically. We have the first papers that investigate if it is effective or not, and the more recent ones at Hoffman, Gonzalez, they are investigating some spillovers from this effects intervention. So we also use some thoughts about this new papers on our study. Okay, and the link between the effects interventions and CIP deviations is not actually new. We have some papers that have already investigated this, as the Garcia and Volpova in 2014 and Walker in 2019. And Walker has a model explaining how the different types of interventions affect the forward premium different. And our main contribution here is to model the dynamics. So we have this this effect, not the dynamics, but and we add this to trying to use a methodology that incorporates the dynamics of these effects. Okay, and the methodology, as I said, we use the ARCO methodology and the local projections developed by Horda. Okay, so just to explain how I'm gonna show the paper, we have just the data, and as I use two methodologies, I will present the methodology and the results separately. So first I use the ARCO, and then I discuss the local projections. Okay. So first, talking about the data. Here in Brazil, as I mentioned, we have this derivative that names coupon cambial. that is basically the local interest rate minus the forward depreciation from the local currency against the dollar. So it is a very known derivative, and the fact we use this is because the spread between coupon and LIBOR is very used and very studied in the literature. And when we state this, the definition of coupon cambial on the CIP deviations, the CIP statement, the equation, we see that we can evaluate the deviation for Brazil simply by analyzing the coupon minus the LIBOR, right? So this is what we do here. And we also have the forward, usual forward exchange market in Brazil, of course, but by arbitrage would be the same. We expect some edge between these two markets. Okay, and for the other currencies, we measure the deviation as usual. So simply by understand the differential between the interest rates minus the forward premium, right? So here is a graph illustrating the interventions we are looking at here in Brazil. So let me explain this. The first one on the top, we have the forward exchange, the interventions on the forward market, right? So here, and the positive indicates the intervention through swap, so selling swap. So the dark blue is basically when central bank is selling swap for the market, right? And over here, between the 2013 and 2015, we have the major program that I mentioned, and this is it consists on a daily intervention. So we see that it's basically the same amount for different periods here. And outside the program, you see that is kind of discretionary. So the amount varies, right? And the period, we also have periods without any interventions. And on the light blue, we have the reverse swap. This is the opposite operation central bank does. And on the green here, we have the same for the repo credit line. So we have the repo sales in the dark green and the repo purchase in the light green. And here on the bottom, we have the spot interventions. And this is kind of actually interesting because on the dark red, we have the purchase. So from 2009 and until 2012 was a time that Brazil was increasing its reserve, international reserve. So these operations in the central bank buying spot on the buying currency on the spot market, it was increasing its reserves, right? On the other hand, we see that the selling of reserves occurs just more recently, okay? And basically this first movement was the central bank changing the mix of the intervention. So he was selling reserves, but at the same time he was using the reverse swap. So this is one fact that I explained that why we do not find the result on the local projection. And more recently, this is due to the COVID crisis. So this is more new one. And okay, talking about the ARCO. So our main question here is looking at the program for 2013 to 2015. What if the central bank had not intervened? So our idea is, well, let's if we could construct two countries, two Brazils, and intervene in one and do not intervene in the second one, and see how how the dynamics change. As we don't have this, the CIP we observe. We just have one where ARCO addressed this question by building a synthetic CIP. So this is basically what the methodology does, and this is a methodology that of the kind of synthetic controls, right? And is more suited for the time series environment. So this is a two-step methodology. So basically we have we construct a control group of countries that did not intervene, and on the pre-intervention sample we estimate parameters to and extrapolate this after the intervention to construct the synthetic CIP deviations, right? The identification, so how we choose the countries that belong to the control group, is countries that did not intervene in the FX market in the period. So this is a hypothesis we have to consider, and this is kind of tricky because some countries are not clear when they do intervene in the FX market or not. And we have also the other hypothesis that ARCO must hold, is that the fact that the interventions in Brazil do not affect the CIP deviation from other countries, and we think this hold as the Brazil is not a big economy in the sense, right? And another issue from this methodology is estimating the CIP deviation. So it's we have some difficulty here because we are dealing in a time series environment in daily frequency, and we are talking about deviation. So I have some difficulty in explaining these deviations. All right. So how we circumvent this problem? We test several specifications, right? We use the variables that commonly attribute to affected deviation as the CDS and the VIX, representing the risks here. And we have some measures of liquidity that bid and ask, the spread between the currencies, right? Measuring some kind of liquidity, and equity index, that's equities index that are very related to the flows, the capital flows, right? So here a graph illustrating what we are trying to capture. So we have in dark blue the CIP deviation for the 12-month maturity for Brazil, right? And the light blue we have the maturity, the CIP deviations for the same maturity for other countries that compose the control group. And here we have the announcement of the program in 2013, right? And we see some increasing here after the announcement, and a higher interest CIP deviations along the time. And the gray, we have the cumulative swap interventions. So as I said, is a daily interventions, and we see this increasing linearly along the time. All right, we have this program has some phases, and the changes the amount they daily intervene, but the idea is the same. And here the control group, as I mentioned, countries that did not intervene on their currencies at the period we are looking at. So to the pre-intervention sample we use is from January 13 until August, because in 2012 we have some interventions made by the Brazilian Central Bank, and we see this affect the parameters over there, and the hypothesis that ARCO hypothesis that must hold. And so here the results, and how I'm presenting the results. It's basically looking at the statistics of ARCO. So ARCO will build a synthetic CIP deviation, and will, on the average of the post-intervention sample, on the average, how is the difference between the observed minus the synthetic, the CIP deviation, right? So for each maturity we're looking at, so until 1 year maturities, each balls here represents the ARCO statistics, and the bars represents the confidence, the 95% confidence interval. And what we see is on the shorter maturity here in 1 month, it's we don't see a strong result, right? Of course, and of course, each color represents the specifications we are working. So this is why we have this on the same value almost here. And for the shorter maturities, we do not see some strong results, okay? And actually in the 3-month maturity, we actually see some decrease of the CIP deviation. But when we look at the larger maturities, we see some consistent results showing that the observed was higher than the counterfactual. So if we don't have this program, the CIP deviation could be lower, right? And how we deal with this steepening of the curve, basically, we think this is very linked with the maturity the central bank was offering the swap contracts and the context of the program. So in the beginning of the program, the maturities were shorter than at the end of the program, and we see this influencing the shorter maturities, and this is behind the fact that we see the steepening on the curve of the coupon and LIBOR spread, right? And as I mentioned in the issue that we try to circumvent is the pre-treatment sample adjusting, right? So we have to estimate an equation that fits the CIP deviation, and this is kind of tricky. And here I'm plotting the adjusted R squared, so as a measure to see how how well this is fitting and the pre-intervention treatment. And this gives a color of how this is gonna construct a consistently artificial. So we see that the shorter maturity, the larger maturities from 1 year is the best explained, but we are seeing a R square of 50. And as robustness, we also estimate our equations with forward premium, and we separated the forward premium and the interest rate. So this is better explained, but we see this kind of tricky to capture this dynamics, okay, in the pre-treatment sample. And moving on to the local projection. So in the second moment, we try to amplify our analysis, and we not look at just for the program that it's very specific because it's a pre-announcement intervention. So let's look at the discretionary interventions the central bank did along the whole period between the 2009 until now. And to do this, ARCO has some issues, right? So and we address the question using another methodology, this the local projection, okay? And this is basically for give some thoughts about the other discretionary interventions. And this is also allow us to understand the interventions of spot market and the repo credit lines, because the program was basically basically forward exchange interventions, not spot and even repo credit lines. And we have some problem of endogeneity here, because this is a hypothesis that the CIP deviation could lead the central bank to intervene. Okay, so if the central bank see the increase in deviation, it could signalize that the market is lacking of some kind of liquidity. And to circumvent this problem, we basically tackle this using the identified shocks, right? So our hypothesis here is simple, that central bank use the interventions. The interventions affect the CIP deviations through the capital flow. So it's a matter of liquidity here, and this is how we think we can use it directly in a straightforward way the interventions explain the CIP deviations on the equations, right? So showing the IRF's results for this local projection, we see here, as I mentioned, in the shorter maturity, we don't see a lot of impact. So this is the same we find in the ARCO, right? And when we look at the larger maturity of 1 year, we see some positive impacts of the one shock and one intervention on the CIP deviations over here, right? And in the reverse swap, we do see some reverse effect. So yeah, as we could expect, this is the opposite symmetrically intervention operation, right? And when you look at the spot purchase spot interventions, we don't see a strong result here. Actually, the IRFs are not showing much intuition. We don't gain much intuition here, but we do see a problem here because, as I mentioned, for the purchase, actually for the selling, we see a small observation. We have a lot, just a few observations in the end of the sample, and this is a specific interventions because they are changing. Central bank was changing the reverse swap contracts and selling reserves, right? On the purchase, we see we have more observations, but we don't see this impacting the CIP deviations strongly. And finally, the repo, we have some short-lived effects here, basically on the sale and the short-term maturity, and we think this is represent what the repo represents for the interventions, right? So as the central bank giving liquidity for the market, and this is kind of we expect, but it's short. It's a term. It's a effect that fade out after the 5 days. It's not have not impacted on the longer term or longer days, as well as we see here in the swap of 1 year, right?
And yeah, I think you have to.
Yeah, I'm just finishing here. I'm concerned.
There's a question in the chat. I don't know if you saw it.
I will see. No, let me just finish here, and I will read the question. So, what we do is link to this to literature. We are trying to add into the literature of the CIP deviations, the variable of interventions, right? And we use the ARCO, the counterfactual, to construct a synthetic CIP deviation for Brazil in the program from 2013 to 2015, and we see on the larger maturity an increase in 30 bips, 35 bips on the average. And looking at local projection, we see some effects here on the forward market. But interventions in repo and spot are not strong or very conclusive. Okay, so that's it from my side. I think I made right on the time. And
Daniel, let me help you with the question here in the chat. Okay.
Okay.
So it's a question from Alex Luis Ferreira. Good morning. I'm in doubt about the structural mechanism by which interventions affect the forward premium. Could you please elaborate on that? What's the limit to arbitrage that you have in mind? Why doesn't the spot rate in the same change in the same amount as the forward rate after the central bank intervention? So of course, this is an empirical paper. We don't take a position on the kind of limit to arbitrage that is acting there. But from my experience in the area, I think what must be playing the role of the financial friction is the balance sheet, or the use of the balance sheets of those intermediaries that buy the forward the forward contracts from the central bank. And we see that that plays a role, especially when Daniel changes the maturity, and the longer the maturity, the larger the wedge is, because then you have two risks. So basically what we would like to do is to build the flow of exchange hedge in the economy. In that earlier paper with Tony Volpon, we tried to do that, because basically banks are buying the contracts, but they're offering the foreign exchange hedge to other actors. But when they do that, they use their balance sheet, and this has a cost. You have to use capital, etc. So basically, I think that these are the kind of financial frictions that end up creating the wedge that we claim to have identified empirically.
Okay, and just to complement what this Alex also asked, why doesn't the spot rate change in the same amount as the forward rate after the intervention? So as I mentioned, we think that it's related to some kind of sample problems. We have just a few observations on this sales of reserves, basically, and this is specific interventions, right? And perhaps we don't capture this in an appropriate way. And when we look at the purchase on the 2009, we don't see much variation, and we think this can be behind this lack of results. I don't know.
No, but I think that there is a financial friction. There are different agents that are in each market, and in order to arbitrage the forward market with the spot market, it takes capital, etc. So yeah, it's a sort of portfolio balance effect, yes. And we are waiting for a general equilibrium model that is good enough so that we can try to fit it empirically, yes.
Okay. Okay, I think that's it from my side. If I have any questions.
Good paper.
Further questions. Sorry?
Good paper.
Ah, okay.
Thank you.
Okay, I think that's it. So thank you all for coming. Thank you, Thomas, and thank you, Ivan, for the presentations.